Hello to everyone. Today I am here with risk and return, one of the most important topics related to the financial management. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover return on investment, types of investment trust, probability distribution, realized return, and different economic occurrences. Return on investment can be calculated by applying the undermentioned formula that is equal to redemption value or the maturity value minus initial investment divided by initial investment. Maturity value and or redemption value are interchangeable words. For example, an investor invested 100,000 and received 115,000 after 1 year. Here we have initial investment that is 100,000, redemption value 115,000, period is 1 year. Return on investment comes to 115 minus 115,000 minus 100,000, that is equal to 1,500, and in terms of percentage, 15,000 divided by initial investment, that is 100,000, the answer comes to 15%. Types of investment risk. Risk is defined as adverse result to your expectation. For example, investor expecting the return for 20%, actual return comes to 5% or negative. So it's a risk. We are not aware about the future return. Types of investment risk. Investor used to invest either in single security, public asset called standalone security or asset, or develop a mix of multiple securities or assets called portfolio. In both types of investment, must face the risk in terms of return or loss. Probability distribution over the period of the investment based on the different possible economic situation occurrences, the expected rate of return on investment is calculated. Here we have two types of the companies. Stocks, you can say, on those stocks, on the basis of different economic occurrences, the interest rate varies from minus 45 to 85. And based on the different occurrences probability, the expected return is calculated equal to 22%. Historical data base realized return over 30 years. Now here we have an example based on the assumption that we have investments in different sectors, sector A to E. The average return against the each sector comes, for example, for sector A, 15%, for sector B, it's 25%, sector C, 8%, sector D, it's 12%, and sector E, it's 5%. The standard deviation for each sector comes to sector A, 25%, sector B, 33%, sector C, 6%, sector D, 16%, and sector E, 4%. Here we have the concept of return and risk. We always say the higher the return, the higher the risk. In first case, as the standard deviation is calculated and its results come in plus and minus. The positive variance from the expected return is considered to be your return, and the negative variance from the expected return comes to your risk. In first case, 15% plus 25%, it comes to 40%. So it's the possible maximum return that we can expect. On the other side, we have the variance from the expected return, that is 15% minus 25%, it comes negative 10%. It's the possible risk that we can have a loss on our investment equal to 10%. In a similar way, for security B, we have a risk of negative return 8%, and in case of a C, it's the positive return expectation is 8%, but we can have a positive return of 2%. In sector D, we can have a negative return of 4%, and in sector E, we can have a positive return of 1%. So from this table, you can have the clarity about the return and risk. Thereafter, here we have the different economic occurrences: boom, above average, average, below average, and the recession. Probability for boom, there is a probability that probability equal to 15%. And above average probability equals to 20%, average probability is equal to 30%, and below average probability is 20%, recession probability is 15%. We have the different sector expected returns. In case of a treasury bills, it remains 22%. It means the treasury bills have no effect of economic occurrences because treasury bills are guaranteed by the state. In case of a pharma, during the boom, we have a return equal to 25%, in recession, it dipped to 12%. Similarly, in case of a food sector investment, it decreases from 45% to 8%. In case of a steel, it decreases from 50% to minus 5%. In the previous slide, we have observed there is no impact of the different economic conditions on treasury bills because treasury bills are backed by the state and their returns are also guaranteed. Treasury bills are also called as risk-free investment, whereas the other investment having the direct impact of the different economic conditions on their returns that we have discussed in the previous slide. Thank you very much. See you again on the upcoming video on the same topic very soon.